Hi everyone, welcome back to the channel. My name is Adam. I'm an expert mortgage broker and today I'm talking about remortgages. We're talking what does it mean, when should you do it, and what are the benefits? Let's go. Now, as ever guys, if you like what you're seeing in this video and you find it useful, please do give us a like and subscribe to the channel. There's new content coming all the time. We try and do a new video every week about all sorts of different things to do with mortgages. So, what is a remortgage? Well, the term remortgage basically just means the process of moving from one lender to the next. Fairly simple. So that's your remortgage, moving from one to the new lender. You're going to want to do that for several reasons. If you want to borrow any more on your mortgage or make any other changes, generally speaking, we need to be moving lenders. The alternative to moving lenders is what we call a product transfer, and that just means staying with the same lender. So you're already with this lender and you just choose a new rate from their current range when your mortgage is due to finish. That's fine if you don't want to make any changes and if you're happy that that lender is still the best one for you, and that is generally not always the case. In fact, you're probably more likely to get a better deal with a new lender than you are staying with the same one. There's certain situations though where you might have to do a product transfer. So if your income has changed and maybe you don't earn enough now to go and get another mortgage from another lender, maybe you've gone self-employed recently and we can't get you a mortgage with a new lender, sometimes we might have to stay with the same one for the next few years. Nothing wrong with that, but it just means that we don't get the choice of the whole market like we'd like to do. So, when are we going to move lenders? Well, you can move lenders up to 6 months before your current rate finishes. So a new mortgage offer with a new lender, not all lenders, but most lenders, tends to last for 6 months. So that means 6 months before your current rate finishes, we can choose a new rate from a new lender. Now that is also earlier, about 3 months earlier in most cases, than you can do a product transfer. So if you are thinking, well, I'll just stay with the same lender, it's easier, well, you can only do that 3 months before. And at the moment, at least, so this is, what is it now, March 2022, rates are going up quite a lot at the moment. So depends when you're watching this obviously, but at the moment rates are going up a little bit, so we're tending to find a lot of people are wanting to refix their mortgage as soon as possible, and you don't get that luxury staying with the same lender, so you can only do it normally 3 months, but if we move lenders we can do it up to 6 months early. There's certain other situations where you might want to remortgage or change lenders earlier than your current rate ends. So if you're on a really high rate at the moment because let's say you bought your house with 5% deposit maybe, but you've done a load of work to your property and now it's worth a lot more and you want to maximise on your new loan to value, so your new increased equity, maybe you want to come out of your fixed rate early to get a lower rate. Or maybe you need to borrow a little bit more. So let's say you bought a property and put in a deposit and now the property's worth a little bit more, but you'd like to borrow some extra money. We'll talk about why you might want to do that in a minute, but maybe you want to borrow some extra money for whatever. Well, the only way of doing that sometimes is by changing lenders. Some lenders, if your existing customers, might lend you a little bit more, that's a different story, but sometimes the only choice is to change lenders. Now, let's think about why we might want to change lenders instead of just staying with the same one. This first point is going to sound quite obvious really, getting to choose from the rest of the market. So your current lender was probably great when you chose them, whenever that was, 2 years, 3 years, 5 years ago, but now they might not be the best lender. You do tend to get a better deal as a new customer going to a new lender. That's not the case with every lender. There's certain high street lenders where you do get quite a good deal if you stay with them, but most of the time, as with so many things in life, you get a better deal as a new customer. Now, we spoke about borrowing more a minute ago. There's a couple of big reasons why people usually want to borrow more on their mortgage. The first is for home improvements. Home improvements is a whole subject on its own, I think, but home improvements could be anything from new carpets, some decorating, a new kitchen, bathroom maybe, or maybe you're planning a whole extension, single story, double story. We've helped people get all sorts of different mortgages, from a few £1,000s for a new driveway and a bit of landscaping to hundreds of £1,000s for massive extensions. So anywhere in between is obviously fine. It depends how much equity you've got and how much you can afford to borrow as well. But that's one of the big reasons why people want to borrow extra money on their mortgage to improve their house. And there's no problem with that. Yes, you're increasing the debt that you owe on your home, but you're usually increasing the value of your home with it. So, people aren't too worried about borrowing extra money on their houses for home improvements, and that's fine. We do quite a lot of that for people. Now, the other reason people want to borrow extra money is to pay off some extra debt. So maybe you've got some loans, credit cards, they can soon mount up, can't they? So we call this debt consolidation. Now, we do have to be quite careful when it comes to debt consolidation, because you're usually taking debt that is unsecured. So a loan or credit card is not normally secured on anything. You just pay it back, and that's that. So we're taking unsecured debt and adding it onto your house. So that comes with its own risks. If you don't pay the mortgage, if you don't keep up the repayments on the mortgage, your home could be repossessed. And that warning statement is everywhere. It's on the channel, it's at the end of the video, it's everywhere. And that's for very good reason, because if you don't pay for your mortgage, the lender can come and take it off you. So we have to think very carefully about whether debt consolidation is right for you. But in a lot of cases, you can see that your monthly expenditure on loans, credit cards, can be seriously reduced if you add them onto your mortgage. And the reason for that is because we're repaying it over a longer period of time. So that can really help people budget each month and bring their monthly expenditure down. And to be honest, I've helped a lot of people do this in the past. And what we tend to find is that not only your monthly expenditure goes down, but actually you're probably paying less interest, because loan and credit card interest can be quite high. We would never tend to consolidate a 0% credit card or any small debts that you could just sort of pay off. But larger credit card debts, loans with high interest rates, when you add them onto your mortgage, can sometimes mean that you're paying a lower interest rate. And actually, I've helped people before where we've had a mortgage term which is longer than their current credit card. Well, you don't have a term on your credit card, but a personal loan. But because the interest rate is so much lower, they've been able to overpay and pay it off quicker than they would have done anyway. And with a credit card, if you're only paying the minimum balance, the minimum payment each month, it's going to take you a long time to pay off the whole balance of the credit card. So we wipe it out in one go, add it onto the mortgage, and then it's a nice neat monthly payment. We can't go doing this every time. So every time your mortgage comes up, if we've helped you consolidate debt before, we don't like to do it again really. We have to be quite careful, but it is quite a good option for a lot of people. So with the right advice, debt consolidation can be quite beneficial for your monthly payments and your overall expenditure. One of the other options when you remortgage or you change lenders is changing the term. So as long as we pay off the mortgage you've already got, as long as we borrow enough to cover that, and then some, maybe if you want to borrow more, or sometimes we see people where they've got some money to put into the mortgage, so they want to pay off a lump sum. So as long as the old mortgage can be covered, then we can change the term. So you might want to take a few years off. So if your interest rate was higher when you bought your property or you last remortgaged, and now we can get a lower interest rate, you might find that we can reduce the mortgage term by a few years. Actually, you end up still paying the same amount. Or maybe your income has gone up a little bit and you can afford some extra monthly payment, and then we can reduce the term as well that way. So that then in summary is why we might want to remortgage, so move from one lender to the next. We can do it 6 months early, and at the moment interest rates are going up quite a lot, so we're seeing a lot of people wanting to do that as soon as they can and refix their rate. So if that is you, or you've got any questions, please do feel free to drop them in the comments below, or send us a message. You can reach us on our website, The link is in the description to the video. I really hope you have found that useful, and you will be back again soon to check out our next video. Take care.